Welcome to Close of Business. I'm Alicia Barry. Financial markets were calling a 97% chance of a second rate cut, and right on cue, the RBA delivered. The official cash rate has dropped from 4.1% to 3.85% in a move welcomed by millions of cash-strapped borrowers. The RBA governor noted weak household spending and growth and significant uncertainty ahead around trade and Trump. David Chow has the story.
Store holders at these markets are hoping shoppers will soon have more cash to splash after the Reserve Bank cut interest rates.
Amazing, that's great. Great for everybody. That way they can spend more on food.
That's good for families, it's good for business, and it's good for workers.
The RBA sliced 1/4 of a percentage point off the cash rate, taking it down to 3.85%. And the big four banks were quick to pass it on. Facing a new set of challenges, the RBA governor remained cautiously optimistic.
I think it's a confident cut in the sense that we think this is the right decision at this point in time.
They've revised down their growth and their inflation forecast. They've revised up their unemployment rate forecast. So basically, they're taking some of the restrictiveness of monetary policy out.
Donald Trump's Liberation Day tariffs have changed the RBA's playbook for where our economy is headed.
Us, just like everyone else, was completely blown out of the water by the scale and the scope.
How concerned are you that inflation might get out of control again, and as a result the Reserve Bank may not be able to deliver further rate relief that so many borrowers are desperate to see?
Interest rates, I know, have impacted people who have loans really severely, and they've been under the pump. We do need to make sure that we keep inflation low and stable. We have got a little more comfortable, just a little more comfortable, that things are going in the right direction, so we can take the foot off the brake just a little bit more.
If lenders pass on the rate cut in full, homeowners with a $500,000 mortgage should see their repayments fall by $76 a month.
This is very welcome relief for millions of Australians. We are really pleased to see more help is on the way for working families with a mortgage.
The RBA governor hinted at further cuts.
If we continue to observe inflation coming down and staying down sustainably, that would give us opportunities to lower the interest rate further.
Economists believe it could be just months away.
I think the Reserve Bank potentially has another 2 in it this year, but again, it depends, of course, on how things eventuate.
We had been expecting about 1 or 2 more cuts next year. I mean, basically our profile for the cash rate is that it will end the cutting cycle somewhere at about 3%.
But if we see any more than that, it could be a sign the Reserve Bank is feeling extra worried about the economy, especially with all that uncertainty sparked by Donald Trump's trade policies, which seem to change day by day.
It's been a complete roller coaster, I'd have to say. There could possibly be a recession, yes, but that's in the very extreme circumstance.
And how much are you looking to borrow?
Any rate relief is welcome news for Bobby Lamb's clients, who've been struggling with higher mortgage repayments.
The general sentiment in the market is still one of gloom because of how high interest rates have still been, and that the household costs are still so inflated.
At least 30 lenders will now offer variable rates below 5.5%, beating all 4 major banks, according to CanStar, while the average variable rate will be just over 5.8%.
So maybe we just talk about your current circumstances.
Bobby says as many as 1 in 5 of his clients are having trouble switching to a better rate.
A fair few clients now under pressure to sell homes instead of being stuck in this mortgage prison where they've got high repayments for the next few decades and not without any ability to do much else.
Tough decisions in uncertain times.
And uncertainty was the word of choice for the RBA governor, as she admitted her team has been blown out of the water by the havoc caused by Donald Trump's trade war. At the moment, the RBA's view is rates will probably come down further, but one man could upend Australian borrowers' rate relief. Economist Saul Eslake joined me. Saul Eslake, welcome to the program.
Thank you for having me on, Alicia.
Now, just as the Reserve Bank celebrates doing away with its narrow path analogy, a new obstacle is on the path in form of the US president. How big an obstacle is he?
Well, I'd say a significant one, but how significant remains to be seen. Just over a month ago, after Trump announced his so-called reciprocal tariffs, it looked as though we were headed for a fully fledged trade war. Now, Trump has stepped back from those tariffs, partly in response to the reactions of the bond and currency markets, which, unlike some others, didn't buckle in the face of Trump's bullying. So it's not simply that the policies themselves are bad, which almost without exception they are. It's the chaotic way in which they're being implemented, suspended, modified and changed that is causing so much pervasive uncertainty. And that's the biggest source of risk to the outlook for economic growth in the United States and around the world. And that in turn is, of course, a big risk to financial markets.
The RBA specifically called out Donald Trump as an uncertainty drag. Given that's the only certainty, how does it approach this?
Well, at the moment, it needs to approach it by waiting to see what happens, what policies, if any, the Trump regime ultimately implements, and then make a judgment as to what the impact is likely to be, not just on the US itself, but importantly on China. What Trump is proposing, not just with regard to tariffs, but also with regard to fiscal policy, could result in higher inflation, in which case the right response might be to raise interest rates. It could result in weaker economic growth, in which case the right response would be to lower interest rates. The Reserve Bank would be well advised, as I think they know, to wait until they can get a clearer read on what would be the right response before deciding what they should do.
Well, one of the huge issues for the US, as identified by the markets and many critics, is a loss of credibility. How do you see this playing out across the term of the US presidency?
Well, one of the most damaging things that the Trump regime is doing is trashing America's brand. In markets for goods, in terms of the US's reputation as a reliable strategic partner for traditional US allies, and of relevance here, the US dollar and the US Treasury bonds status as safe havens during times of uncertainty, even if, as occurred during the global financial crisis, it's developments in the United States itself that have been the source of that uncertainty. But on this occasion, it would seem that the financial markets are losing their faith in the role of the US dollar and US Treasury bonds as a safe haven. And so we've seen, although the stock market has recovered some since Trump's back down on tariffs, that bond yields remain elevated and that the US dollar remains weak. And it's really only gold and the Swiss franc that are playing the role of safe havens. And given the risks now posed to the outlook for the US budget and public debt by Trump's so-called big beautiful bill, the risk is that that safe haven status that the US dollar and US bonds have had for more than 80 years is going to be further eroded over time.
The RBA has a lot of firepower to cut rates in the face of these risks. What do you think it will do?
Well, if the risks turn out to the downside, as the Reserve Bank laid out in the statement on monetary policy released earlier this week, then they will cut rates possibly quite aggressively. The cash rate is now at 3.85%. That's still well north of the range of 3 to 3.5% that the Reserve Bank regards as consistent with neutral monetary policy. So they have scope to take cash rates down, if not to where they were during the COVID pandemic, then certainly to a lot lower than they are today.
Is there a risk here that we could see growth deteriorate as such in the US, that we see a recession?
Well, yes, that is a significant risk, and the risk stems primarily from the uncertainty that the policies which the Trump regime is pursuing and the chaotic way in which they're being pursued. It's quite likely that if Trump's policies push the US economy into recession and they also cause a marked slowing in the Chinese economy, it'll be very difficult to avoid a recession here in Australia as well.
Saul Eslake, thank you so much.
That's a pleasure. Thanks for having me.
Donald Trump's 90-day temporary trade truce with China ends in early July. The de-escalation easing market concerns over a collapse in US-China trade relations for now. While it's unclear what a peace deal will look like, Reserve Bank Deputy Governor Andrew Hauser, who was in China on Trump's so-called Liberation Day, says don't count China out. Business editor Michael Yander was across his speech.
Well, interestingly, he went the week after the Liberation Day tariff announcement by Donald Trump, which, from Andrew Hauser's experience on that trip, shocked everyone in China in the magnitude of tariffs announced. They'd been expecting something like maybe 40 or 50 or 60% tariffs, but anything above 60% was seen as an effective embargo on Chinese exports to the US. So they were caught off guard. But interestingly, the assessment of the Chinese economy at the time was that it had been turning a corner since September 2024, when the Politburo in China had intervened with extra stimulus, which was seen to be effective, and it also reached a kind of resolution with the private business sector in China, freeing up more private investment. And of course, there was the boost to confidence from the DeepSeek AI announcements that the Chinese tech sector was really starting to take off. There was a rough consensus that the tariffs on Liberation Day might wipe up to 2% from Chinese GDP, but that was before any stimulus response, and we have seen a stimulus response since from the Chinese government, and also, of course, since then there has been a deal to wind those tariffs back at least temporarily to 30%, and so that will reduce the growth impact on China.
My goal was deliberately narrow, to set out what I heard in China in the immediate aftermath of Liberation Day. That narrative at that time was pretty positive, that the Chinese economy was seen as picking up in early 25, that China felt it had a strong hand in responding to the economic impact of tariffs, and that Australian companies in China saw opportunities amidst the risks.
Now, China's government's targeting 5% growth, so 4.8% wouldn't be too bad. Now, interestingly though, Michele Bullock, the RBA governor, is travelling to China next week. So 2 visits in the space of a couple of months from the RBA's 2 most senior officials show you just how critical they think the Chinese economy is to Australia and how much they want to understand on the ground what the economic situation is in China.
To the share market now, and despite all of the news, it ended pretty flat. The ASX 200 and the All Ords finishing up the trading week 0.2 and 0.1% higher. US bond yields spiked this week as Donald Trump pushed ahead with his big, beautiful tax bill, undeterred by the bond market warning bells. The wide-sweeping tax cuts and spending plan passed by the House of Representatives by just 1 vote in the early hours of the morning.
If you guys really think these are such great, awesome, beautiful things to do, like Trump keeps saying, then why not hold this hearing at 1 p.m. and not 1 a.m.? Why not debate this bill in prime time when most of the American people can watch? It's 1 o'clock in the morning. I think it's prime time in Guam.
Democrat lawmaker Jim McGovern there. Julia Lee, head of client coverage at FTSE Russell, joined me. Julia, we saw bond yields, particularly those 30-year yields, spike, but it wasn't enough to stop Donald Trump pushing ahead with his big, beautiful tax bill this week.
The US Treasury market is probably the most important asset market in the world, and that's because we use the risk-free rate when we value all assets, so it's in all asset valuations. And the fact that we are seeing the US Treasury yield above 5% means a number of things. First of all, long-term borrowing costs have gone up, which makes it difficult for businesses as well as economies to grow. But secondly, it also sends signals on inflation and interest rates, and it sends signals that perhaps inflation will be higher and that rates may be higher for longer as well. And then thirdly, of course, bonds have become relatively more attractive over time, and that if these conditions persist, that could mean more volatility for the share market.
Yeah, it's interesting though, as Donald Trump increases his debt load, pushing toward $137 trillion US now, the interest rate he's going to be paying on it has also gone up with it.
Yes, we've seen US debt really ballooning over the last decade. In fact, if we have a look at the end of last year, US government debt stood at 130% of GDP, and we know that debt ceiling's coming up soon as well. But not only that, we've seen those longer-term interest rates rising. If we have a look at historically, they have been higher. If we look back to the 80s, the 30-year Treasury yield spiked to over 14%. But the last few decades, that's been quite unusual. I mean, it's been unusual to see rates of 5 to 6%. But if we continue to see rates sort of around a 6 to 7% mark, that would really signal a lack of confidence in terms of how the US manages its debt.
And when we look at demand for long-dated bonds, we also saw an auction in Japan for 20-year bonds that wasn't well received. What happened there?
The reason why the Japanese bond market is important is not only because it's the third largest bond market in the world, but Japanese investors hold so many foreign assets. So if we have a look at US Treasuries, they hold 12.5%. Now, the weak bond auction in Japan means that Japanese yields have risen. So Japanese investors could pull their money out of US Treasuries and back into Japan. And that, of course, would cause instability in terms of the bond market.
I mean, this so-called big, beautiful tax bill that Donald Trump has just got through the House of Representatives in the US, what could it do to the outlook for the US economy?
If we have a look at the big, beautiful bill, you know, tax cuts, and it does look like it's relatively stimulatory, but the big thing will be to watch how the bond market reacts. Part of the bill is to raise the debt ceiling, which is coming up in July. So we do still have to see it go through another part of government to pass. But it does look like, you know, it is designed to help stimulate economic growth with those tax cuts and some other measures in there as well.
Well, interestingly, because of the US debt situation, we saw Bitcoin touch new highs.
Yes, we have seen Bitcoin rising, I think around about 60% over the last 52 weeks. And there's a number of factors. Bitcoin is a lot more accessible now. We have exchange-traded funds which allow retail investors to access it. But also regulatory environment is helping as well. In particular, the US, a stablecoin bill, which looks at things like compliance as well as reserves. And it does look like that's a step closer to passing. So we have seen Bitcoin more supported. And then let's not forget the US currency as well, that weaker US currency with a lot of these cryptocurrencies valued in US dollar terms means that these assets go up. Things like gold, Bitcoin, they benefit from that weaker US currency.
Well, share markets were pretty flat this week. What are the implications of all of this for equity investors?
Well, there was a lot going on underneath the surface. We saw interest rates in focus, interest rate cuts in Australia as well as in China. We saw the market pricing in that Moody's cut of US debt. And then, of course, a lot going on in terms of the regulatory front in the US as well with the big, beautiful bill. But if we have a look at the markets, up by 0.3% here in Australia because interest rates were very much in focus. We saw those interest rate sensitive areas doing well. Property, telecommunications, as well as tech were the star performers.
Julia Lee, thank you.
Thanks, Alicia.
A war of words has erupted between the country's two biggest mobile providers. The consumer watchdog is considering allegations by Vodafone that Telstra has inflated claims about its mobile phone network size and misled consumers. Telstra denies the accusations. This story is brought to you by Rihanna Whitson with Amelia Terzon.
In remote areas like this, farmers typically have only one option for mobile phone coverage.
I wouldn't say that Telstra have been lying to us, it's just they haven't been telling the whole truth.
Peter Thompson says the telco service claims are unreliable.
I'd really love to see a map of usability rather than a map of where the signal's getting to.
Now, in a rare public spat between mobile network operators, TPG Telecom-owned Vodafone has accused Telstra of engaging in misleading and deceptive practices.
It's essential that as Australia's largest telco that they are transparent, that they're clear, that they are straight up with Australians.
Vodafone says that Telstra gained an unfair market advantage by using inflated mobile coverage figures in advertising and sales materials based on the use of external antennas.
Telstra has been grossly over-exaggerating the size of their mobile network by more than 40%. And maybe the most startling part of that is it looks like it's been going on for more than 15 years.
Before being contacted by Vodafone, Telstra's website claimed its network covered 99.7% of the population with an area of 3 million square kilometres, 1 million more than any other network. By the 12th of May, the telco changed its website to say its network covers 99.7% of the population when using an external antenna, and added a link to its coverage maps.
The only reason we've done that is because Vodafone are making it explicit how they show their maps. So in the name of transparency, we have done the same and made our way of measuring it explicit.
Telstra admits its coverage claims have always been based on the use of external antennas, but denies that it's misled customers because maps were always available elsewhere on its website.
If you look at our maps, it's very clear that you can choose between the external antenna coverage and a handheld coverage.
In reality, it's estimated that Telstra's coverage without the use of an external antenna is much less, at 1.9 million square kilometres.
That's nearly 1 million square kilometres. It's a huge amount. That's the size of New South Wales, Victoria and ACT combined.
According to Telstra's maps, Peter Thompson's property should have full 4G coverage, but that's not possible even with antennas and boosters.
We've seen some horrendous Telstra advertising. When they start putting a marketing spin on something that is so crucial to us, you then start to lose some faith.
We know that Telstra does have some form in deceptive and misleading conduct, and that's a concern.
Consumer advocates are backing Vodafone's call for the ACCC to investigate.
If it proves to be true, is a serious allegation that does indicate that Telstra are actually restricting competition, and in turn, for consumers, that does mean an increase in prices.
The ACCC is considering the issues raised by Vodafone's owner. The watchdog said in a statement that there is no legal requirement for telcos to publish comparable and accurate coverage maps, but it would like to see increased transparency.
At the moment, the telecommunications companies put coverage maps on their own websites, and they state that these are the levels of coverage that consumers can expect. But of course, we have no way of verifying that information.
Leaving consumers to discover mobile black spots the hard way.
Superfund Hester is under fire for taking its online portal offline for nearly 2 months. Dozens of members have contacted the ABC to complain that they were caught unaware and had great difficulty accessing their own money. The company says its customers were alerted in February, but there's growing outrage among members who say they didn't receive the message. Adelaide Miller reports.
Annette Mumford is transitioning to retirement, and she says she hasn't been able to access her money because of an outage at her super fund.
I find it very distressing, and I'm just gobsmacked that they have not even notified their customers.
She's been a member of Hester for decades.
Hester is a super fund that supports the people who spend their working lives helping others.
The superannuation fund has been offline since April, while it changes administration providers.
I was so distressed thinking, oh my gosh, because there's no time for planning because it had already closed down without me knowing in advance. And I called them and put in a formal complaint about 2 or 3 weeks ago and just got a lame reply back saying, oh, we're really sorry that you didn't get the email.
Jane is also a member of Hester. A recent injury means she can't work and is on the verge of losing her home. She received advice about accessing her super, but then realised Hester was offline.
That made me feel very dejected and more panicky. Yeah, I was in a panicky state. I was thinking, what can I do? What can I do next?
Hester says it notified customers back in February about the planned outage, sending nearly 1 million members an email, as well as 87,000 letters. A spokesperson said, where emails bounced, we followed up by sending the significant event notice via post.
Some super funds just don't have up-to-date contact details. They should be making the effort to call people and let them know that they're going to be subject to this period of time where they won't be able to access their money and what they can do to mitigate against any harm that might cause.
The director of Super Consumers Australia says the situation isn't good enough.
HESTA should have mitigated against this in the first place. It seems like they've forgotten what their job is, and that's to pay people their money in a timely way so that they can meet these types of costs that they've got.
The HESTA spokesperson admitted there are temporary disruptions to some services, but members can still receive urgent and critical payments and switch investments.
When I first reported on the super outage last month, dozens of people wrote into the ABC, distressed they couldn't tap into their super. When I spoke to HESTA, the super fund insisted that I provide the names and contact details for these individuals so the super fund can escalate the claims.
Super funds shouldn't be outsourcing their customer service to media outlets or to consumer organisations. They should be dealing with this problem themselves.
Daniela Patey's client was in the process of pulling money from his super to buy a property and almost lost his deposit.
We didn't settle on time. I was able to negotiate an extension of the settlement date, but since then we've been issued with a default and rescission notice.
She tried to contact the super fund and lodged an online complaint. She called a financial insider to help escalate his claim, which has now been paid, but not without a significant toll.
Because of this upgrade, he's been caught out and he's now having to deal with the emotional and financial burden.
A burden many HESTA members are still facing. The super fund system comes back online on the 2nd of June.
And that's all from Close of Business. For more on those stories, you can go to our website and catch The Business Monday to Thursday evenings at 8:45 Eastern on the ABC News channel and after the late news on ABC TV. I'm Alicia Barry. Thanks for watching.